recently defaulted on a $562.5 million loan backed by a portfolio of secondary European properties. This development has sent shockwaves through the financial community, signaling potential financial strain for Blackstone, which oversees assets exceeding $1 trillion for both institutional and individual investors. The default not only exposes Blackstone to significant financial risks, but also prompts concerns about the broader stability of the global financial system. Given the substantial reliance on firms like Blackstone for liquidity and credit, this event raises pertinent questions about the health and robustness of the financial infrastructure. The situation is compounded by Blackstone's earlier default on a $38 million mortgage for a Manhattan office tower, reported by the New York Post over a year ago. The sale of this debt at a steep 50% discount underscores the seriousness of the challenges facing Blackstone and highlights the depth of the predicament. The recent turmoil in the financial world has brought to light a crucial lesson. Even behemoths like Blackstone are susceptible to financial woes. History is replete with examples, such as the downfall of Enron, illustrating that size and stature do not guarantee perpetual success. This serves as a stark reminder that no entity is invulnerable. Surprisingly, some were taken aback by Blackstone's involvement in mortgages, given its reputation for investment prowess. However, the reality is that even financial giants utilize borrowed funds to enhance their investments and maximize returns. In this case, Blackstone's withdrawal from a prime Manhattan location, potentially their headquarters, led to the failure of the commercial mortgage-backed securities, CMBS. The distress in the real estate market, particularly the commercial sector, is palpable as defaults on loans become more common. These distressed debts flooding the market are being sold at alarming discounts, causing a domino effect that adversely impacts various aspects of the financial system, notably pensions. Blackstone's default is not an isolated incident, but indicative of a larger trend in the real estate market. Office buildings like the 26-story Art Deco tower in question are struggling to attract tenants and meet mortgage obligations. As more distressed debts emerge, they are being sold for fractions of their original value, signaling a deteriorating situation. The orchestrated sale of Blackstone's defaulted loan raises questions about market confidence in absorbing such distressed assets. The discounted price prompts speculation about further depreciation or potential market panic if high-profile defaults become more common. Government and regulators are closely monitoring these developments, recognizing the potential cascading effect on CMBS. Preparation for a real estate downturn becomes crucial as savvy investors seek opportunities amid the chaos. In essence, Blackstone's default serves as a litmus test for the health of the real estate market. As more distressed debts hit the market, their sale prices will reveal the true extent of market stability, making readily available funds essential for weathering potential storms. The broader implications for the economy demand our attention. Blackstone's default is not just an isolated incident, but a symptom of a larger issue affecting the entire banking sector and economy. The banking sector, still reeling from the global financial crisis of 2007-09, faces new challenges exacerbated by low interest rates maintained by central banks like the Federal Reserve. While intended to stimulate the economy, these low rates have reduced the profitability of traditional banking and encouraged excessive borrowing, potentially leading to a debt bubble. The broader implications for the economy demand our attention. Blackstone's default is not just an isolated incident, but a symptom of a larger issue affecting the entire banking sector and economy. The banking sector, still reeling from the global financial crisis of 2007-09, faces new challenges exacerbated by low interest rates, maintained by central banks like the Federal Reserve. While intended to stimulate the economy, these low rates have reduced the profitability of traditional banking and encouraged excessive borrowing, potentially leading to a debt bubble. Additionally, stringent regulations post-crisis have increased costs for banks, ranging from compliance to technology investments for cybersecurity. The sector's inability to meet customer needs, particularly during the pandemic, has further eroded trust and market value. Blackstone's default exemplifies these challenges, potentially leading to increased credit risk and loss for banks, decreased confidence in the banking sector, and a reduction in credit availability for the economy. The recent default on 1740 Broadway, one of Blackstone's flagship properties, underscores the complexities of real estate investment in the post-2008 era. The significant decline in value raises questions about the sustainability of real estate investments, especially in the face of market corrections. This situation serves as a cautionary tale for investors, urging them to navigate the real estate landscape with a deep understanding of market dynamics and potential risks. In essence, Blackstone's default highlights broader economic vulnerabilities and underscores the importance of prudent decision-making in both banking and real estate sectors. Given the current trends and conditions, it is both possible and probable that Blackstone and the banking sector will need to prepare and respond to this scenario by adopting appropriate policy recommendations. Blackstone should initiate reforms and restructuring within its portfolio and business operations, addressing financial issues, enhancing risk management and compliance measures while restoring credibility and confidence. Cooperation with creditors and regulators is vital, providing clear, transparent information and explanations about defaults, along with fair compensation and adherence to relevant laws. The banking sector must also collaborate, sharing information and knowledge to manage risks and challenges effectively, aligning with the interests and goals of the credit market. Blackstone's default is indeed shocking and alarming, signaling significant financial difficulties and risks for one of the world's largest alternative asset managers. This event raises concerns about the stability of the global financial system, which heavily relies on firms like Blackstone for liquidity and credit. It's crucial to recognize that Blackstone's default is not an isolated incident, but symptomatic of broader issues affecting the banking sector and the economy. It serves as a wake-up call for increased